Welcome to Mark Arnold's Finance. Today I'm going to do something very unique. Not a lot of people would be willing to share their negatives, their failures, so I'm going to share with you guys my biggest investing failures. And the whole point of this is to help you guys see what I've done wrong in hopes that it helps prevent you from making the same mistakes. We all fail. We all fail at things, but there's something important. There's a saying that I love, and it says, sometimes you win, sometimes you learn. So I don't consider them failures as long as you learn from them, and that can be applied to anything in life. So if you appreciate this type of transparency, this type of openness, be sure to subscribe to my channel. I'm somebody that provides diverse content. I share my portfolio performance with every single video, which I'm going to do at the end of this video because I want to be able to go through my failures, show you my portfolio, and then point them out a little bit more concretely. And so that's what I plan on doing today. I think this is something that a lot of YouTubers or figures that promote their portfolio, their investing strategies, they usually only share the positive. That's not what I do on this channel. I share the good and the bad because that's how you learn, right? Nobody's perfect. And if you're following somebody that's only sharing the good, you have to wonder what bad stuff are they not sharing, and that could set people up for traps and failures that buy into what they share. So we're going to go over my biggest failures. I have about 8 points here, maybe a little bit more, and I really hope this is helpful for you guys. I really hope that this shows you that it's okay to not have a perfect portfolio, and we're all learning, especially if you're new to investing. I feel that's where I made my most mistakes, is early on. So let's get started with this video. My first investing failure was buying what others tell me to buy. That is something that I think is very common when you're new because you do not have that education. You do not have that experience underneath your belt. So you're very easily influenced, and you're being a follower at this point, right? You're not a leader in your own investing. You're following others. So early on, I made some bad investments because I was just listening to YouTubers or other platforms and people talking about stocks and, just saying, all right, I'll buy into it because you say X, Y, and Z, that sounds good enough. Well, it didn't turn out to do too well for me. One of the big stocks was Tattooed Chef. I follow this YouTuber, Jeremy's financial channel, something like that. And I think he's okay, but I think he definitely has more of a marketing personality. So he talks things up very well. And I think he has a lot of invested interest in a lot of the stocks he promotes. So that was one where I just fell right into having someone else tell me what to buy instead of, doing my own research and more things. So that was my first investing failure, was just listening to others and going off what they say, being a follower and not a leader of my own portfolio. The next investing failure was doing no research whatsoever. I think it's easy to be lazy, correct? If you're in school and someone says, hey, you can just have my answers, I bet you majority of people would take that option. But the people that choose to do their own work, their own homework, are the ones that are gonna come out better in the end because you're gonna actually know what you're looking at. You're gonna actually know what you're buying. And so doing your own research, that's something that it took me a while to understand that I really wasn't doing myself justice because I was just being lazy with my investing and going off of what others said to buy. And so that was one of my investing failures, is thinking I knew a company or a stock just by what was in my own head instead of actually taking some time to read some articles, do some research, and more. So that was another failure. The next investing failure was chasing yield. This is a big one I see out there with a lot of investors, as they see those high dividend yields and they just want to buy into them regardless of what the other financial metrics or measurements of that company are. So two companies that I can give an example are of AT&T and Altria. Altria is a tobacco company, AT&T a telecommunications company. They both pay high attractive yields, but yet their stocks have been horrible. In fact, let's take a look. AT&T over the last 5 years has lost 44.5% of its stock value. That is massive. So instead of, growing at the annual 8% a year, you're going down pretty much. You're going opposite of what the market should be doing. Then if we look at Altria, we will see here that it's very similar over the last 5 years. It's been mainly in the red. It's down 34%. So these are two stocks that a lot of people will chase the yield because their dividend yields are 7, 8, 10%. But what people don't understand is, they'll see that 8% yield, and that's what they like to promote and brag about. Oh, I'm earning 8% on AT&T. But what are your unrealized losses? If you put those into the formula, you'd actually be losing money. And what you should be telling people is, hey, I am losing 2% a year or 5% a year in this investment. Because if you were to sell at that point, would you be in the green or the red, including dividends? I guarantee you it would be the red. So you have to be careful of chasing yield. I definitely did that with AT&T and Altria. And if I did the research like I talked about and all those things, I would have never bought into both these stocks. They were ones that I was not told, but I went off of what somebody was promoting. I didn't do my research, and I was looking at that high yield and seeing that as easy money, but in fact, it's just been losing me money. And you'll see my portfolio with AT&T, I'm in the red, and Altria, luckily I was able to get out in the green very slightly. But regardless, chasing yield, usually companies put up a high yield because there's other fundamentals of their companies that are going down, right? They might be having negative revenue, negative earnings, negative cash flow. There's a lot of things that you have to consider. So if you're just focusing on that yield, you might be ignoring a bunch of red flags. So that's just something to keep in mind. My next biggest investing failure was not taking the time to understand ratios and measurements. So it's very important when you do your research, right, not being lazy, that you know what you're looking at. An example is the PE ratio. This is very popular, and how a lot of people will look at this in the lazy way is a low PE ratio equals good and a high PE ratio equals bad. And I can tell you that's not further from the truth. It's not so. Let's take two companies, Microsoft and AT&T. Microsoft's PE right now is about a 24, 25, where the S&P 500 average is at about a 16. So it's definitely much higher than the S&P 500. Its 5-year PE ratio average is about 35. It has a 35 PE. Now, AT&T, their PE is low. It's at a 5 right now. So a lot of people will see that as AT&T as the bargain, and that's been the case for a long time. But let's look at how these stocks have performed. If we look at AT&T again, of course, they were down over the last 5 years, 44.5%. That is nasty, right? That's not good. If we look at Microsoft, it's a very different story. They're up over the last 5 years over 200%. And that's even with the decline recently. So what you have to do is not just look at the PE ratio. You have to understand all the measurements, all the different metrics of a company, and know that, hey, it also matters, are they growing earnings? Are they growing revenue? Are they growing their free cash flow? There's a lot of other things to look at. Are their margins good? So if you just see a low PE ratio, just like the high dividend yield, but not look at anything else or understand what it means, because a low PE ratio does not mean it's a good investment. Just like a high PE ratio doesn't mean it's a bad investment. So that's something that you have to do, is understand, take the time to really understand the different measurements and ratios, financial ratios of a company, because that's going to really help you see outside just, kind of the blinders that a lot of people just look at, like with the PE ratio. So that was another investing failure. The next one is being impatient. I can't tell you how many times me being impatient has, cost me some gains. What I really am focusing on is saying, I will put up a price point, right? I will research a company and I'll say, okay, I'm willing to buy in at this company at this point or below because I feel that that's a good valuation, that's providing me a level of safety. Instead, I get impatient and it's kind of flirting up here, the stock, and I just say, screw it, and I buy it. And then what does it do afterwards? It goes down and it gets into my price point. Most recently, a recent one is Ally Financials. This one, I was saying to myself, you should buy under $30 per share. Well, I got impatient and I bought, and my average was $33 and change. And what has it done afterwards? It's gone down to as low as $28 per share. Right now, it's in the $29 range. So what I am saying is learn to trust yourself, especially if you do the research, and don't be impatient, right? Because if you've done your research and know that a company is overvalued in your research and with your strategy, don't be pushed in by your impatience to buy it. Just wait, because if it goes down, great, you buy in. If not, then maybe you pivot to a different stock. So being impatient was another failure. The next failure is buying too many stocks. I've done a lot of research on this, and it's recommended that a portfolio should have 15 to 20 stocks. I've done a video on this, but really what it comes down to is when I first started investing, I had over 30 stocks. I was coming up to 40 stocks, and I was ready to have 100 plus stocks. But what is not good about that is there's no way you can do research on that many companies. It would be a full-time job, and I ain't got time for that. I got my own job, I got my own life, and so I want to be able to laser focus on stocks that I'm really bullish on instead of worrying about just filling my portfolio with a lot of fluff, shall we say. The other thing is it's better to have, a few companies that you really have research and feel are high quality with higher dollar amounts than have, let's say, 100 stocks each with a couple hundred or a couple $1,000, because your gains are going to be minimal should one of those companies take off. So there's a lot to be said there, but buying too many stocks in the beginning. Luckily, I was able to research this, learn it, and turn it around quickly. And now I think with my individual holdings, I think I'm closer to that 20 mark. I might even be under that or at that. So buying too many stocks was another failure. The next biggest investing failure was buying hype or popular stocks. Of course, Tattooed Chef is my prime example. I'm down massively. You'll see here in a little bit at the end when I show my portfolio performance. But this is the case when stocks are popular. Usually what that means is it's probably overpriced, right? It's got hype, people are buying into it, it's pushing up the stock price, and that's the wrong time to buy in. But that's when I bought in. Again, I was listening to somebody else. I wasn't doing my own research. And if I would have researched, at the time that IPOs, speculative stocks, SPAC stocks, whatever you want to call them, they were so popular at the time. That's what everyone was pouring money into. And if I would have taken a step back, I would have said, you know what? Investing in companies that don't really have a history of financials yet is not a good thing. Investing in companies that are very popular, probably not the right time. And, without having history to go off of, you're really just throwing a dart blindly. Because with Tattooed Chef, if I would have waited for another year of financials, I would have seen that their earnings are negative. Their margins are horrible. And I'm not saying that it won't turn around someday, but I'm just saying it would have kept me out of that stock and I wouldn't have had a large loss like I have now. So buying those hype popular stocks, you have to be careful. I think it's okay to take a small risk in those small companies, those IPOs, those speculative stocks, but be very cautious that you can't just go off of, I think this will do good because there's no history. It's usually better to wait till you see how they start to perform and develop before you buy in. And like I said, when stocks are very popular, that usually is the wrong time to buy in. So that was another investing failure of mine. The next one is, I think, can be said for all of us, but that's not starting sooner. For a long time, I wanted to invest, but I was fearful of it. For some reason, it was scary to me, right? To put my money into the hands of companies, right? By buying their stock. And so I wish I would have started sooner because, as you know, the longer you invest, the more opportunity you have to make money because that snowball effect is real. Once you start earning those dividends, reinvesting, those companies grow long term and they split, they start paying dividends if they don't. There's a lot of things positive that can go on with time. The sooner you start, just the better. So that's a big thing that I wish I would have done. So now let's look at my portfolio, right? This is a transparent channel. I want to be honest. And so let's look at it and I want to point out a few things. So we will see here that recently we saw the job numbers came out and they're positive. They're higher than what they were expecting. So that's a negative thing because that means the market's anticipating more rate hikes. So we saw a red day today on October 7th. We'll see what next week brings. But regardless, I am down 9.5%. At my high, or shall we say lowest, I was down over 10%. So I'm flirting with that again. But I want to point out a few things. Let's start with Meta. Meta, I'm down nearly 40%. So I see this as something that I did something wrong. I probably invested too much too soon. I also, if I took a step back, I would have heard the news and seen the inflation happening and realizing that one of the first things to be cut would probably be advertisement dollars. So again, there's things if you just take the time, do your research, it'll make you probably come to some realizations that you wouldn't otherwise and save you from some loss, from losing money. So with Meta, I do think long term this will be good, but I would have stayed out of it if I would have just thought about it a little bit more, the big picture, right? And it's not always just looking at the ratios and the measurements, it's looking beyond that as well, right? So seeing inflation rising, what would be hurt most? Well, advertisement dollars. And Meta's huge. Most of the revenue comes from that. So if I put two and two together, I would have not have invested at Meta at the time, and I could have got in 40% lower than I did. If we move over to Tattooed Chef, of course, this is my biggest loser. As a percent, I'm down over 70%, and that does hurt, right? It does hurt to show this to you guys, but I'm happy to show it to you guys because I want to be transparent and honest. I want to share these things with you, so hopefully you don't make the same mistakes. So luckily, it's a small percentage of my portfolio. Anything in purple is the market share allocation. So with Tattooed Chef, again, I fell into the hype, the popular stocks. If I took a step back, I wouldn't invest it. If I waited for a few earnings, I wouldn't have invested. And so I got into this company, and I hope someday I can get out, because right now, being down over 70%, I hate seeing this every time I look at this summary of my portfolio. If I move over the international one, VIXIS, it's down over 17%, but I will say this one's not a failure, and I'll tell you why. There's no way you can predict what is happening internationally. I bought into the stock, one of my first holdings, so it's over 2 years ago. So all I'm going to do is just average down. I don't see this one as a failure. Financials are one of the most undervalued sectors right now, so I don't see this section as a negative. I'll just keep averaging down. Communication, of course, AT&T, of course, Warner Bros. Discovery got spun off, so I'm just going to put these under the same kind of category. I chased the yield. I listened to somebody else. I shouldn't have done that. I should have seen the high debt with this company, the bad decisions it's made in the past, and it would have caused me to stay out of this stock. So because of that, I'm down 32% in AT&T and over 42% in Warner Bros. Discovery. And I do think AT&T is now finally getting on the right track, turning things around, focusing on lowering their debt, but we'll just have to wait. So hopefully it'll be in the green so I can probably exit this holding. If we keep going, I will say the only other one I want to point out is 3M. I am down over 27%. My allocation is high, I will say, so I think I overinvested, and I think I did not put enough weight towards its litigation issues. That's really hurting it right now. I also, if I took a step back and looked at this, I think this will be a solid long-term hold, but it's not going to be a high growth hold. And if I would have looked at it, I wouldn't have invested the amount of money that I invested in this. Right now it's at a 3.63%. If you take away that 27% loss, let's just say, it's at a net zero, this would be much higher, probably closer to 5-6% of my portfolio, which is definitely too much for 3M in my opinion. So right there, my mistake was not factoring in the litigation issues, not factoring in that this isn't a high growth. So I definitely went too heavy on my investing with it. And so we'll just have to hopefully wait till this gets into the green, and then I will probably cut this position, not fully, but probably by a decent amount, maybe 50% of it. So that's my portfolio, just kind of showing you a little bit more in depth of my failures by companies and why. So follow along. You'll see this portfolio with every video and see how it's doing. And hopefully long term, of course, I'm a newer investor, 2 years into it. Long term, 5-10 years down the road, I want to see this growing massively and being in the green. Again, I want to share with you that saying, sometimes you win, sometimes you learn. We all are going to fail at things. It's just how it works. You can't learn unless you fail, right? Unless if you make mistakes. It's just how you treat those situations. So if I would have failed at some of my investments and saw some losses and gave up, because I see a lot of people do that, right? They see some of their holdings go into the red and then they just stop investing, or they sell out at a loss and then they don't invest at all. That's not what you do. What you do is you learn and you evolve your portfolio into something stronger. And that's exactly what I am doing. Investing in quality companies and learning along the way, and this portfolio will get stronger and stronger. And the hopes is that if you follow me, that you see the results of my growth, right? Learning from my failures and focusing on, what I've learned and the quality companies that I do want to invest in, the long-term investments that I should be focusing on, things of that nature. So because of that, I feel like my portfolio is just getting stronger and stronger, and yours can too. And so I want to end this with some advice. I think what you should do and what I should do is write down your failures, right? I did it for this video. Write down those failures, write down maybe your fears, and really study them and focus on them, so that way you know what you can start learning and start focusing on, so you don't make these mistakes or make the same mistake twice. So that's my advice. Also, my advice is create a metrics chart, something that I share with most of my videos. It's something that I can utilize to put a lot of different ratios and measurements of a company, so it helps me see a picture in a different way. So let me pop this up here real quick and show you guys. So this is what I've created. Some of what I consider my most important measurements that I want to look at for a company, I put them down and I analyze it, right? So this is one I did recently. I compared Costco versus the industry. If I only looked at the PE ratio, that might cause me to just stop right there. But if I kept looking and saw, hey, their earnings, they have growing earnings, they have growing revenue, they have growing cash flow, they have healthy dividend growth over the last year, they have a healthy dividend payout ratio, they have low debt, they have good return on equity, their shares outstanding are going down, so they're not diluting me as a shareholder. There's a lot of good. It could go the opposite, right? You can see a low PE ratio, but then see negative earnings, negative revenue, negative cash flow. And that should cause you to take a closer look and be like, hey, this probably isn't the investment I'm looking for. So I would say create your own metrics chart. What really matters to you, what you think would cause you to be bullish or bearish on a company, and stick with it. Take the time. Don't be lazy. Take the time to do your research on your holdings or your possible holdings, so that way you can keep track of them, because things can change, right? I could be holding, let's say, Ally Financial, and right now I really like the metrics on it, but then things could change as I update this, and then I say, hey, you know what? It's not going where I thought it was going, and so I would sell it at that point and put my money towards something else. So I hope this video really helped you. Again, it's not something a lot of YouTubers would do. Share their failures, share your negatives, not just the positives. I showed my portfolio. It's in the red, almost 10% now, but I'm okay sharing that with you because I think this time that we're in right now is an accumulation time. We're getting a rare opportunity to buy stocks at great valuations. You just have to do your research and see what those are. But also, I'm willing to share with you things that have hurt me. So hopefully you can take those and apply them to your investing strategy. Keep those things in mind so you don't get bit by those things that I got bit by. And that's what this really is sharing things with each other. So if you have any failures that you'd like to share, please comment down below, because whatever can help us, this is a family, right? This is my YouTube family. You guys are following me on this journey, so I'm going to be transparent with you and honest with you. I owe you that. And so I really hope you appreciated this video. And if you do appreciate this type of transparency, again, be sure to subscribe, give my channel a shot. I think you'll really like it. And with that said, we'll see you next time on Mark Arnold's Finance. Have a great day.